This Friday morning. Thank you all for joining the CXOGenie Masterclass. It's a pleasure to have you all with us today. Before we hand it over to Deepak, our speaker for the day, I would like to take you through a little bit about CXOGenie and the CXOGenie app. CXOGenie is a platform that was started about 7 years back with a handful of CXOs, and today we're proud to say that we stand at 1,000 plus CXOs who come together with the common objective to solve any given problem for each other within 15 minutes. And the three pillars of CXOGenie are the 15-minute solutions, the quickest that are there, those that are of the highest quality, simply because we have 1,000 plus years of cumulative CXO experience amongst all of us, and the cost effectiveness of the platform. Some of you would have, who joined earlier than 9 a.m. Would have seen the video bite by our member, Jignesh Kenya, where he spoke about the mastermind concept. And that is the very core of CXOGenie. The mastermind concept was formally introduced by Napoleon Hill in his book, Law of Success. And it's defined as the sum total of minds of two or more people, who work together in perfect harmony for the attainment of a common goal or of a definite purpose. And this is a peer-to-peer mentoring group, and it helps its members solve their problems with inputs and advice from like-minded peers. It's said that a well-constructed peer group serves as an anchor for learning, and that is exactly what we look to provide our CXOGenie members to make their journey at the top a little less lonely. The mastermind concept is one that can help you accomplish in 1 year more than you could have in a lifetime without it, if you depended solely on your own efforts for your success. And while a lot of us might have read the book and know about the mastermind concept, we at CXOGenie find ourselves lucky enough to see this happen on a day-to-day basis across all our forums, be it the CFO Genie, the CHRO Genie forum, the Supply Chain Genie, the Marketing Genie, or Founders Genie. Our platform is one that is by invitation only, and for that we always encourage our members, our genies, to refer their peers whom they feel can benefit from the forums. And you can see this, the QR code if you would like to refer somebody or check your eligibility as a CXOGenie member. Please feel free to do so. We also have an Amazon referral reward in place, where there are vouchers worth 2,000 to be won from Amazon. On your screens, you can also see the upcoming sessions. If you would like to register, please do using this QR codes. We'll also be sharing the registration links on the chat. For the Amazon voucher, I'm very happy to announce Mr. Indrajit Sengupta from CHRO Genie, who's won an Amazon voucher this week. So Indrajit, if you're on call, congratulations. You will be receiving the email with the voucher from us soon. I'd like to hand over to our CTO, Mr. Jay Sampath, to take us through a few features of the CXOGenie app.
Thanks, Swati. Thanks, Swati. Hello, esteemed members. Today we are going to quickly look at a couple of features onto the CXOGenie app. First of which is the discussion forum. A discussion forum is a place which is built for the members and by the members. A forum where you can ask your queries and expect it to be resolved really quickly. So, say for example, in order for you to ask a query, just click on the ask a question on the top, type in your question, select the forum you want your question to be posted, and select tags if you want to be very specific, and just click on the post button. Now, at times you may, as a CFO, have, or as a CHRO, have questions related to finance, or a CFO may have questions related to HR. For them, it would be very easy to just select the cross forum, wherein they can select a CHRO forum and post the query. How it works is, the system's intelligent bot would take this question to the CHRO forum, and when someone responds from there, you would receive a notification. How the topics work here is, while you have asked a query, people get a notification, and while they respond, you get a notification. So let's see, the topic works in a threaded manner. So in this case, Mr. Rodriguez has asked a question where a couple of members on the CXO platform have responded. You could also share a particular topic, outside the system if you need to. It would create the thread very similar to this, like that you see on your screen. You could also bookmark a particular discussion for future references. There is filter by tags available. So, for example, I want to filter any announcements. I could filter that. This helps you posting a query which is very definitely focused towards a particular topic. So if you want to search for, say, for example, GST related discussions, you could filter it by GST as well. So that's the small demo that I wanted to do about today. Over to you, Swati.
Thank you, Jay. As we begin the session for today, introducing our speaker, Mr. Deepak Kewalramani, to all on the platform here today. Deepak is the co-founder of Flip Carbon, a finance professional with over 25 years of experience in FMCG, food and beverages, retail, engineering, construction, and petrochemicals industry. Deepak comes with expertise in ERP implementation, business turnaround, new business development, business acquisition, and integration. Deepak has extensive knowledge and experience in business partnering with senior executive teams, leading large teams, and business development. And before starting his entrepreneurial journey with Flip Carbon, Deepak has worked with the Enhanced Group, Sab Miller, Perfetti, Vanwell, PepsiCo, and Reliance, to name a few. Welcome, Deepak. Over to you.
Thank you, Swati, for the nice introduction. Good morning, everyone. Thank you for joining on this session on a Friday morning. I'll just share my screen. Give me a minute. Can you stop sharing the screen? Yeah. Is my screen audible? Is my screen visible?
Yes.
Sorry.
Yes.
Yeah. Thank you. Thank you, Swati, for the nice introduction, and thank you, CXOGenie, for having me on this wonderful CXOGenie platform, giving me an opportunity to take this session. And good morning to all of you, and thank you for taking time out on a Friday morning for this session. So before I start, I would like to introduce Flip Carbon to you for a couple of minutes. I'll just take a couple of minutes. So Flip Carbon is an integrated management consulting firm. We advise and support business leaders, working collaboratively with them to maximize their organizational potential. We work across a wide variety of industries and deliver results in strategy definition and execution, business performance improvement, organizational effectiveness, and transactional support. One differentiating factor about Flip Carbon is that our business is driven by in-house experienced consultants who have worked across domains and industry verticals, and that too in leading organizations with rich experience at leadership levels. So we actually bring a unique balance in both strategy formulation and impeccable execution. So that's a bit about Flip Carbon, and let's start the session now. So talking about employee taxation and managing ESOPs, basically the schedule for the day is, so we will actually talk about a tax-friendly compensation structure, which is also tax compliant from the employer's point of view. Then there is the alternate tax regime which has been introduced for individuals in the recent budget 2020, which actually gives an option to an individual to either select the existing tax rates or the alternative tax rates, subject to certain exceptions and limitations. Then post that, we will evaluate, we'll understand a bit about ESOP, evaluate the different structures on ESOP, look at how ESOP taxation works for registered startups and unregistered startups and other companies. So there has been a budget amendment again where some benefits have been given to registered startups. Then it will be followed by a Q&A. Moving on. So when we talk about compensation structure, and that to a tax-friendly compensation structure, what is the objective here? The objective here actually is to enable the employee to increase his take home. And also, but from the employer's point of view, it's very critical that whatever the tax-friendly structure is rolled out is actually tax compliant, because the onus of withholding tax is on the employer. And also because there are other onuses like maintaining impeccable record keeping, collecting, supporting and valid proof of documents which prove expenditure. So it kind of leads to an administrative hassle and cost for the employer. However, in the current scenario where many companies are outsourcing the payroll processing to expert payroll processing companies, and Flipcarbon is one of the few companies. We have that service also, where we offer payroll processing services. Also, one more important thing to look here is the circular which is issued by CBDT every year on TDS reduction on salaries, which talks about the various perquisite valuations, the various allowances which are taxable, non-taxable, the kind of documentation that is required, the TDS that needs to be deducted, and so on. So it's important that the employers ensure that whatever tax allowances which are being offered, which are non-taxable, should be tax compliant, and so that there is no withholding tax liability coming on. Moving on, so what I've tried to do here is create a compensation structure for three types of salaries: 10 lakhs salary, gross salary of 10 lakhs, followed by gross salary of 25 lakhs, and followed by gross salary of 50 lakhs. So basically, this is the gross salary. So the retirement benefits, which generally is given by the employers, like employers' contribution to PF, and then gratuity, and health and medical insurance and life insurance, which doesn't form part of the gross salary. Some employers have started contributing to NPS, which again is one of the few deductions that is allowed under the alternate tax regime. So basically, here the second column is shows the flat structure where just the HRA, LTA, basic, and special allowance are considered, and whereas the structure two is actually where we talk about some non-taxable allowances and reimbursements, starting with mobile and internet reimbursement, children education allowance, vehicle fuel and maintenance reimbursement. A point to note here is that the assumption here is the vehicle is owned by the employee and used for official purposes only. Here again, the record keeping has to be impeccable in terms of log books, meter readings, the relevant bills and the vouchers as well, so that if there is a challenge by the tax officer, we have like impeccable records which don't create a tax liability on the employer. However, if the vehicle is used for both official and personal purposes, then the deduction is limited to 21,600 per annum if the engine capacity is less than 1600 cc, and 28,800 if it's above 1600 cc. And if a driver is provided, an additional 10,800 rupees benefit is available. Also, one thing to note here in the budget amendment, there is a cap that has been put on employers' contribution to NPS, National Pension Scheme, Superannuation, and Recognized Provident Fund, which is limited at 7,50,000. Any contribution over and above that would become taxable. So theoretically speaking, here also one more thing, one assumption here is that against the HRA of 2,70,000, only 1,80,000 is paid by the employee. Hence, the deduction based on the rules and the tax and the section, it works out to 1,26,000, and the entire amount of LTA is actually spent on a domestic trip. So, considering all these non-taxable allowances and reimbursement, theoretically, an employee can actually earn a non-taxable salary of 3.06 lakhs. However, he has to submit valid proofs and documents which actually justify that expenditure. Also, in the current scenario where most of the people are working from home, the employees can look at fixed asset reimbursement for computers and mobiles for a reasonable sum, say 50,000 for a computer and 30,000 for a laptop, and which can be claimed once in 3 years. Moving on. So for the next salary bracket of 25 lakhs, everything else is kept the same, except for the vehicle fuel and maintenance reimbursement, where the company can sorry, there is an error here. So it's basically vehicle fuel and maintenance reimbursement is being kept at 150,000, because the employee can actually earn the employee can pay for the driver. He can actually drive a better car. So overall, the other allowance remain the same, and with that kind of a structure, and again the HRA is considered to be payable as 4,20,000. So considering all this, the employee can theoretically earn a tax-free tax-free salary of 5.85 lakhs. Moving on to 50 lakhs, actually, there is some issue here. Even in 50 lakhs, there is a the overall allowances are kept the same. However, the vehicle fuel and maintenance reimbursement has increased to 3 lakhs, and considering HRA deduction and LTA spend, employee can theoretically earn a tax-free allowance and reimbursement of 11.05 lakhs. So moving on to the old tax regime versus the new. Basically, in the Income Tax Act for 2020, alternative tax regime has been introduced, where lower tax rates have been allowed for individuals. However, the existing tax rates also continue, and the difference basically is under the under the existing tax rate, under the existing tax regime, the tax rates are higher, but the exemptions and deductions are allowed under the Act, like Section 8IC, 8ID, NPS reduction and on. Whereas under the alternative tax regime, the tax rates have been reduced. So the tax rates are the same up to 5 lakhs at 5%, and then they increase by 5% for every 2.5 lakh increase in the tax slab up to 15 lakhs, and beyond 15 lakhs, the tax rate is 30%. Whereas under the existing tax regime, the tax rate between 5 to 10 lakhs is 20%, and anything about 10 lakhs is increase is 30%. There's a cess of 4% payable on the total tax computed as per these slabs. So basically, the onus of selecting an existing tax regime or a new tax regime is on the employer. Sorry, on the employee. And all individual assessees can change the regime every year, except for business except for assessees who have business income, who can actually change once in their lifetime, and again they're allowed one more change. So looking at the tax rates, the alternative tax rates may look actually attractive, but considering some of the benefits and the exemptions allowed under the existing regime, the existing regime could be beneficial for some assessees. So we'll look at it with some examples. So understanding the old and the new regime at 10 lakhs gross per annum with various scenarios. So we have built up 4 scenarios for the existing tax regime and the alternative tax. And then there's one scenario for the alternative tax regime. So the first scenario is basically where the employee gets has a HRA deduction, LT reduction. He also has a non-taxable allowance, which we discussed in the earlier slides. And then he also gets a standard deduction, and there is a limited investment for 8IC deduction, and he invests about 10,000 in medical insurance. So considering that, and then the scenario 2 is where there are no non-taxable allowance. He has a flat structure. And then scenario 3 is where it's similar to scenario 1, but the interest on housing loan has been introduced. And scenario 4 is a scenario where the employee actually doesn't pay any HRA, probably stays with his parents, or he stays in a PG, and he just gets a standard deduction and also a limited deduction to the extent of his PF contribution. So this is a case where the employee is not investing in any of the tax saving schemes, nor in health insurance. So considering these 4 scenarios, if we see, the scenario 1 and scenario 2 and scenario 3 are definitely better under the existing tax regime, because the employee pays lower tax. However, if it goes to scenario 4 under the existing tax regime, then the alternate tax scenario works, because here the employee doesn't invest anything, and hence if he opts for the alternative tax scenario, then the his tax liability comes down. Also, there has been one more amendment in the budget where interest on housing loan benefit has been extended to rupees 3.5 lakhs, subject to certain conditions under Section 80EA, which is basically on affordable housing. So condition like this should be the house should be his first house. The stamp duty value of the house should not be more than 45 lakhs. The loan should be taken from a financial institution or a housing finance company, and so on. Moving on to the next scenario, where we look at 25 lakhs gross per annum, where the again the 4 scenarios have been built similar to the earlier slide. However, in these scenarios, we have considered the maximum limits allowed under Section 8IC and 8ID, which is 1,50,000 and 25,000, and also the maximum limit under Section 8ICCD for NPS reduction. So even under this scenario, in this slide, scenario 1, scenario 2, scenario 3, they all are favorable scenarios for the existing tax regime. However, the scenario 4, where again the employee is not paying any HRA, and he's not actually claiming any LT deduction, he's not investing in any tax saving instruments. So in that case, the scenario 4 is not a favorable scenario under the existing tax regime, and he should opt for the alternative tax regime. Similar scenarios for 50 lakhs gross salary per annum. The scenarios remain the same, and here again the scenario 1, scenario 2, scenario 3 actually are beneficial for under the existing tax rate regime, and scenario 4 is not beneficial, where the alternative tax regime would work for the employee. So basically, it all depends on the employee as to whether he really wants to get benefit under Section 8IC and 8ID by investing in tax saving schemes, or taking health insurance, or planning for his retirement and investing in national pension scheme. But if an employee believes that he needs more money in his hands, and he is not interested in investing in all these tax saving schemes, so then the alternative tax scenario, alternative tax regime works better for him, where he will end up paying lower taxes because the rates have been reduced. Now moving on to the employee stock options, basically the employee stock options is an attractive scheme for the employers, where they can actually through this ESOP attract and retain talent, and it particularly works for startup companies where they're not able to pay the higher fixed salaries for a better talent, and then they bring in a mix of a lower fixed salary and an ESOP option for the employees and bring them on board. And also it's a tool where they can motivate and retain that employee. Also, from the employer point of view, it helps from the employee point of view, it helps them to create wealth, and it also enables them to become stakeholders. From the employer's point of view, it helps them to align the employees' performance and their KRAs and KPIs with the company's strategy and the company objectives. It enables the employees to reward high-performing employees high performing employees, and also who display passion and who display passion and long-term interest in the organization. In the coming slides, we'll also talk about the different structure of employee stock options. Basically, the ESOP plan, which is the most prevalent plan. Then we'll talk about ESPP, which is employee stock purchase plan, restricted stock units, and then stock appreciation rights settled in cash or in equity. Now, before we go on to the ESOP, understanding the ESOP and the taxation of it, it is important to understand the key terms for ESOPs. So basically, the key terms are grant date, the date on which the employer grants the ESOP to the employee. It's the date of the agreement. It enables the employees to buy shares at a later date. Vesting date is the date when the employee is entitled to buy shares after certain conditions are fulfilled, like a vesting period or certain other performance related conditions. Vesting period, basically it's the time period between the vesting date and the grant date. Exercise period, so once the options are vested, then the employee gets a particular period, say 1 month or 2 months, to actually exercise the stock options and buy those shares from the company. However, it's not an obligation. The employee may not choose to exercise the option. Then exercise price is basically the price at which employees exercise the option. The price is usually lower than the prevailing fair market value. However, it cannot be lower than the face value of shares. Then coming to the different structures that I was referring to. So basically, there is a ESOP plan, which is simple and prevalent in India, basically, where there's grant of options, vesting of options, followed by exercise and followed by allotment. Employee stock purchase plan is a plan where the employees are offered to buy company shares at a discount to the fair market value. Generally, in such, this is used by companies in a scenario where they want their share capital to be increased, and also during IPO process, the employees are offered shares at a discount. Coming to restricted stock units, are similar to ESOPs. However, the only difference is that the RSUs have an underlying condition like target revenue performance-based, like revenue targets, profitability targets, and so on. So if these targets are met, then only the option vests. Otherwise, that option is lost for the employee. And then the stock appreciation rights, basically, basically these are in the form of cash or equity to the company, to the employee, which is basically the difference between the share price on grant and the share price on exercise. So the difference can either be settled in cash or in shares. So I have actually experienced this stock appreciation rights in my earlier organization, Samular, where a similar scheme was in operation, and based on the vesting period and the difference in the grant price and the price on the date on which you sold the stocks, you used to get that difference in cash from the company. So taking an example to understand the taxation better for ESOPs. So basically, if suppose the grant date is on 1st July 2020, and A has been given an option to purchase 10,000 shares of ABC Private Limited. ABC Private Limited is an unlisted company, and which is not registered under Section 8I IAC, where the exercise price is 60 rupees per share. Now the vesting period here is 3 years. So on 1st July 2023, the option would vest in the employee at the end of 3 years. And as per this example, the employee has only a period of 1 year, 1 month to exercise the option. So on 31st July 2023, the option is exercised. The fair market value at the time of the exercise is 80 rupees per share. So here the employee is actually getting a benefit of 20 rupees per share, that is 2 lakhs for 10,000 shares. However, he doesn't get any cash. It is just that the option is exercised and is just a notional benefit which accrues to him. In such a scenario, for this notional benefit, the perquisite value of 2 lakhs has to be offered to tax, and the employee has to deduct tax at the prevailing rates and based on the slab under which the employee comes. So if the employee is coming under 30% slab, there will be 30% tax levied on 2 lakh rupees. Now, coming to the next milestone, where where A sells the shares on 31st Jan 2025. So basically, he's selling the shares in less than 2 years from the exercise date. And here, for the purpose of simplicity, we assume that the exercise and transfer of shares happens simultaneously or within a couple of days. So here, so he sells the shares in less than 2 years time. So here he at a rate of 120 rupees. So he makes a benefit of 40 rupees, which is 120 rupees sale price minus 80 rupees exercise price, a fair market value at the time of exercise. So that 40 rupees again into 5,000 shares, 2 lakhs will be subject to short-term capital gain tax and will be taxed at the prevailing rates and at a tax slab under which the employee operates. So again, if it's 30%, the 2 lakhs will be subject to 30% tax rate. Then the next milestone is when he again sells 5,000 shares at 150 rupees each on 1st Jan 2026, which is more than 24 months from the date of exercise. Here he is making a benefit of 3,50,000 rupees, which is the long-term capital gain tax, and this long-term capital gain tax will be subject to 20% tax plus the applicable cess. So cess is applicable on all taxes at 4%. And however, if the employee falls in a higher bracket above 50 lakhs, there's an additional 10% surcharge which is attracted. Moving on. So basically, trying to understand better in terms of the taxation on ESOPs. The stage one is talking about the perquisite, where on exercise of the shares, if there's a perquisite value that is coming to the benefit of the employee, that is subject to tax, and the employer's responsibility here is to withhold the taxes on the perquisite value and actually show it the same in the withholding tax certificate and the withholding tax return as applicable. Talking about sale of shares, which is capital gains, although we talked about it in the earlier slide, but here I would like to bring in an element of a listed company and unlisted company. So if it's a listed company, then security transaction tax is paid on it. And in such a scenario, the short-term capital gain tax will be subject to 15.6% tax and not at the applicable slab rate. Which is there for the non-listed company, and even in the long-term capital gains, the period is 1 year for a listed company and 2 years for an unlisted company. So if the employee is holding the shares for more than 12 months for a listed company, it becomes a long-term capital gain, and similarly, if he is holding the shares for more than 24 months of a unlisted company, it becomes a long-term capital gain tax. And also here the tax rates are different. It's 20% for unlisted shares and 10% for listed shares. Also, there is a 1 lakh limit for long-term capital gains on listed shares. So long-term capital gains up to 1 lakh is non-taxable. One more thing here is on long-term capital gains tax, there is an indexation benefit available. So depending upon the indexation benefit in the indexation rate in the year of sale versus the year of exercise, the employee could get some of the indexation benefits, and the capital gains may be lower than in the earlier example where it was 3,50,000, it could be lower than 3,50,000. So talking about the budget 2020 amendments, the expectation from the budget was to avoid double incidence of taxation on ESOP, basically at that point of exercise and at the point of sale. And also there could be an instance where the employee actually ends up paying tax on perquisite when he exercises the option. However, for whatever reason, the fair market value after that falls, and then he makes a capital loss whenever he sells the shares. So that capital loss has to be offset against capital gains only. So he ends up paying higher tax on perquisite and then incurs a capital loss. So just to avoid all that, the expectation was that the ESOPs will be only taxed at the point of sale. However, the government has given a different amendment where only only startups registered under Section 8I IAC and who further satisfy the conditions like it must be incorporated on or after 1st April 2016, total turnover shall not exceed rupees 100 crores in the previous year for which the exemption or the benefit is being claimed, and it must hold a certificate of eligible business from the Interministerial Board of Certification. So talking about this Interministerial Board of Certification, it's very difficult to get the certification. It's apparent from the numbers that are available, basically where as against around 28,000 startups registered under the DIPP, only 600 or 700 startups have got this certification from the Interministerial Board. So basically this amendment is only applicable to such startups, and the amendment is basically the tax would accrue in the year of exercise. However, the TDS on the perquisite which the employer needs to deduct and pay to the treasury has been deferred to the earlier of the following events. So the first event is expiry of 5 years from this year of allotment of exercise or allotment of ESOPs. So herein, actually the government has given 5 years to the employee to actually enable him to exit from the ESOP and sell the ESOP, so that there is no cash flow issue for the employee, because on exercise there is no cash benefit accruing to him. It's a notional benefit, and the tax which is deducted on perquisite actually is deducted from his salary, so it impacts his cash flow. So with this 5 years, the employee can actually plan an exit and exercise accordingly, so that his cash flows are not impacted. Then if the employee sells the ESOP, then date of that sale, and if the employee exits the company, then the date of that exit. So earlier of these 3 dates is when the employer needs to deduct the TDS and pay into the treasury. So basically, to conclude here, this amendment is only beneficial for the registered startups under 8I IAC, and for all other startups and for all other companies who have ESOP schemes, the earlier provisions on taxation would apply. So some of the key points to consider for ESOP is that ESOPs can only be given to permanent employees. It cannot be given to full-time professionals because they're not permanent employees. The scheme can include future employees as well. Minimum vesting period, however, should be 1 year. Exercise price cannot be less than face value. However, it can be set at a discount or a premium to the fair market value. Exercise price can be different for different employees. No maximum or minimum threshold on quantum of ESOPs or number of employees participating. This is particularly for an unlisted company. Then ESOPs cannot be shared without voting rights. And for calculation of perquisite value, fair market value of the organization has to be done by a merchant banker. The company also can amend the ESOP policy to increase the exercise period. However, it has to do it through a special resolution and explain the reasons for this amendment. This will enable the employees to actually, as I explained earlier, to plan the exit in their ESOPs and avoid and defer the cash flows on perquisite taxation. And there is no specific provision in the Income Tax Act restricting or adding compliance for the above change. Some more key points to consider. So there are some companies who also have where they are extending the excise period post termination or exit of the employee. So the employee is getting additional number of years after exiting the company to exercise the options. And the pros for that, as I explained earlier, is the employee does not have to pay tax on perquisite upfront and exit. He can defer the tax liability at the time of sale of shares. He can actually plan his exit, combine the exercise and the sale transaction in the same assessment year, and so that there is no cash flow issue for him. And there is no chance of capital loss if the fair market value of the share reduces under this mechanism, because fair market value and the exercise price would remain the same if he plans his exit accordingly. However, one of the cons which should be considered is that the employee could end up paying higher tax on perquisite if his income tax falls under the highest tax slab. So basically, taking our earlier example, on exercise of options, the employee, even if he was on the highest tax bracket, would pay 30% tax. And when he sold the shares after 2 years, the capital gains was only 20%. So there's a 10% impact on the employee if he plans to exit and exercise in the same year. So he could actually pay tax at the highest slab. And whereas if there's a capital gains involved, then the tax, and if it's a long-term capital gain tax, then the tax is only 20% or 10% in case of a listed organization. Something which I came across, which I thought I will bring it up here, is suppose there's an employee who has been granted an ESOP and his vesting period is 3 years, and during those 3 years he's been working 1 year each in India, Australia, and the US. And suppose after 3 years the perquisite value comes to rupees 1,50,000. As per the tax laws and the treaty, the perquisite will be taxed on a proportionate basis, that is 50,000 each in USA and Australia. However, in India, the entire perquisite value is taxable, but the credit for the taxes paid in US and Australia will be allowed. And there is no known litigation till now by the department in allowing the Indian company to give credit of the above taxes while withholding tax on the entire perquisite value. So basically, the Indian company can give credit for the taxes paid in US and Australia while withholding tax on the entire perquisite value. Thank you for your time. This is from Team Flipcarbon, and if you want to reach out to me, my email ID and my mobile number is given below. Thank you so much for your time. Now we'll take Q&As.
Thank you so much, Deepak. We'll take the Q&As now. I'll read out the questions for Deepak to take up one by one. The first one is from Vishal Garg. Regarding the fixed assets reimbursement, do we capitalize them in the books of the company and depreciate over 3 years?
Yeah.
All right. Kanan has 2 questions. I'll take them one by one. About the 5-year tax deferment on ESOP allocation. The first question is that, is this applicable for sweat equity allotment as well?
Sweat equity, I need to study in detail. I'll have to study and get back to him on the sweat equity piece.
Not a problem. And the second is, what does recognized startup mean? Only self-certification on DPIIT site, or something up over and above that under ATIC or interministerial group? How do we get that recognition?
So basically, there has to be an application made to the interministerial board for registering the startup. And what I understand is the startup needs to be very innovative and into deep tech, or it has to be solving a very big problem for the interministerial board to actually give that certification. So it is not a DIPP certification; it is an interministerial board certification.
Thanks, Deepak. Sushant Dalmia would like to ask, what is the maximum amount that can be claimed under vehicle, fuel, driver, mobile, and internet allowances?
It depends on, there is no limit specified, but it has to be reasonable. So the employer has to actually decide on the limits based on the kind of expenditures are incurred for the business purposes. So it has to be reasonable, otherwise it will be challenged.
Understood. Sanjay Kumar Jain's question is that, is any documentation required where an employee takes a benefit of vehicle reimbursement being used for both official as well as personal use?
So basically, the employer has to certify that the vehicle has been used for official and personal use. Also, the employee needs to maintain proper records of the logbook, the meter readings, justifying that, okay, so much is business purpose and so much is for personal purpose. So those documents are critical for getting those deductions.
Sure. Uh, Ashwini Khemka's question is, does SAR or phantom stock options dilute cap table? I've been told to understand that for new age companies, these are better instruments as they are not affected in fully diluted cap table.
So basically, if it's SAR which is settled by cash, there is no shares issued under that. So basically, the difference between the exercise price and the grant price is given in cash to the employee. So there are no share issued. So it will not dilute the cap table. However, if the difference is settled in equity shares, definitely it will dilute the cap table.
Sure, thanks Deepak. Before we go ahead, Pratiksha has shared the feedback form link on the chat window. Would request everyone to kindly fill that in and that will help us, maybe pick up any topics that you would like to take up. And also if you have any further queries for Deepak, please fill that in and we'll be happy to share them with him. Going on to the next question, Ram Ranjan Sharma is asking, when exercising the option, will tax have to be paid without the cash flow being notional?
Yes. So if under the ESOP scheme, an employee is exercising the shares, so and if the fair market value is higher than the exercise price, definitely the difference is treated as a perquisite. As I said, it's a notional perquisite. It doesn't give any cash in the hands of the employee, but as per the law, if it's not a registered startup under Section 8 IIC, the tax has to be deducted in the month in which he exercises and has to be paid into the treasury.
Thank you. Sanjay Jain's question is that in ESOP, if the sale happens at a price lower than the exercise price, can he claim a capital loss on the same?
Yeah, so there's a capital loss which can be offset against the capital gains.
All right, sure.
Yeah.
Joy Jain would like to ask, is it 5 years from allotment or 5 years from exercise?
So basically, generally exercise and allotment happens simultaneously within a period of 10-15 days. So as an employee, if I'm paying cash for some shares, I would like the share certificate with me, ASAP. So generally, unless you are exercising on 31st of March and then the allotment happens in the next year, generally it happens in the same year.
Thanks, Deepak. Mahesh Iyer would like, further clarity on what it means that not for full-time professionals.
So suppose a lot of companies, rather than keeping employees on a fixed employees, they keep professionals and pay professional fees to them. So these professionals are completely associated with the company. They work only for the company, but rather than being called as employees, they're called as professionals and they get professional fees. So those are the full-time professionals. So if it's a full-time professional, there's just he gives a bill for professional fees. TDS is deducted. But definitely there is a GST element involved there. Whereas in case of an employee, there is other compliances like PF, ESIC, and so on.
Got it. Rajesh Batra's question is related. Can we give ESOPs to whole-time directors or promoters? And if not, then what is the alternative?
See, earlier it was not allowed. Basically, up to 10%. If the promoter and holder is holding up to 10%, then no ESOPs could be given. But for now, registered startups under DIPP, that has been that limitation has been taken off, and now it can be issued if the startup is registered under DIPP. The promoters can be given ESOPs.
Sure, thanks, Deepak. Gopal Rajakrishnan would like to ask, can you give a perspective on equity shares for mentors or advisors?
For mentors or advisors, it will be like, paying, rather than paying professional fees, you would be paying in terms of equity. So in such a scenario, it is just a settlement of a services provided. Rather than settlement being in cash, the settlement happens in equity. And then we'll have to look at elements like what happens to GST, what happens to TDS. But yes, it can be done subject to compliance with these taxes, these tax laws.
All right. Kamal Nath would like to ask, what if employees move on and ESOPs are fully vested and is allowed few months or few years to exercise, what happens to tax incidents in such cases?
The tax incidences remain the same. So taking an example, like I'm working with an organization, ESOPs are already vested, and then since the employer is allowing me to even exercise the option after my exit, I move on from the company. And when I see that there is a benefit in exercising the option, the fair market value is really beneficial and I can actually exercise and sell the options, then I would choose to exercise the options. And as soon as I choose to exercise the options, the employer will have to, he'll not allow me to exercise unless I give him the TDS on the perquisite value. So that's how practically it would work. So the ex-employer will take the money of the TDS on the perquisite value and then only give me shares.
Got it. There's a request for Deepak's email ID and contact. Can I request Pratiksha to please put that in the chat window? In that case, that will help everyone, whoever needs it. Going on to the next question, Akash would like to know, what if turnover goes beyond 100 crores in the next year after exercise of shares?
So in my opinion, then that 8IIC benefit is lost, but it needs to be dwelt in detail. I haven't checked on the element, but prima facie that benefit under 8IIC would be lost.
Right. Dhaval State's question is, ESOPs are typically granted at exercise date or corporate event, whichever is earlier. What in your experience are such corporate events?
Corporate events have not experienced, but as I said, it could be certain performance related events like company achieving or the employee achieving a certain target or the company achieving a certain profitability. So those kind of events could lead to RSUs being vested in the employee. And if those events don't happen, then that option is lost. If that's what he means by corporate events.
Yeah, Dhaval, I hope your question was that's what you meant. Akash has another question. If startup is registered with certificate from Interministerial Board, but registration under 80AIC is not granted,
it has to see once the interministerial board approves, then the section 8IC is granted. I don't understand the question. If you could actually.
Yeah, Akash, if you could just elaborate it further in the chat, we'll come back to it. Adarsh Agarwal is asking if employee of foreign subsidiary received options from Indian company with vesting period 1 year. For the entire vesting period, the employee has never visited India. Will the employee be liable to pay the perquisite tax?
See, basically, it depends on the tax treaty between the country he's working in India. But if he's completely out of the country for the entire 1 year of the vesting period, so that the particular earning has happened outside of India, and if he's termed as an NRI, then definitely it will not be taxed in India. But we need to understand the treaties between those two countries.
All right, thanks, Deepak. Question from Prasanna. In case of transfer of shares from promoters to advisors or consultants, what is the tax implication for the transferor and the transferee, and company is not yet profitable?
Sorry, repeat that. I didn't.
Sure, I'll just read this again. For example, if there's a transfer of shares from promoters to the advisors or consultants, what is the tax implication for the transferor and the transferee? And the example that is given is that the company is not yet profitable either.
So as I said, it is the settlement of services. So there's a service rendered by advisor. So he'll have to raise a bill for it, and he'll have to charge GST on that, and he has to pay that GST to the government. And in lieu of that, the company is giving equity shares rather than cash. So in my opinion, the applicable TDS has to be deducted and deposited. And then the shares can be given to the advisor. So taxes would remain the same. It's just the mechanism of settling for the services. So there will be definitely GST which needs to be charged by the advisor on his bill. And when the promoter is settling the bill, through equity, he has to deduct withholding tax and pay to the treasury, for which the advisor can get benefit when he files the returns.
Nitin Dadu's question, can ESOPs be issued to consultants? If not, what needs to be done to show him part-time employee, and can he then be eligible?
It can be issued, as I said, taking this example forward, which we talked about, advisors, consultants, they are the same thing.
So coming on to the next question, Anjali Bharbade would like to ask, will the capital gain treatment remain same if shares are listed outside India?
If shares are listed outside India, that's a valid question. Haven't come across such a scenario, but I will respond to her. I study it and respond to her.
Sure. Ashok Sharma's question is, in the example that you gave, is tax payable on 10,000 into 60 as perquisite?
Which example? Sorry, if you could.
Ashok, if you can elaborate, we'll try and come back to that question. Badrinarayan's question actually, sorry. What happens to shares allowed as performance bonus to the employees? Tax treatment for the employer and employee.
Shares allotted as performance bonus. So again, as I said, it's a mechanism of settlement. So rather than paying cash, bonus is being issued. So they'll definitely be treated as a perquisite and taxed. So bonus is a part of salary, right? So it's just a settlement, whether it is settled in cash or settled in a form of shares.
Sure. We have a few minutes left. We'll try and cover as many questions as we can. In case they do get missed out, please do fill in the feedback form and put in your questions there. We'll be happy to forward them. Vijay Kumar is asking that, does the corporate events mentioned earlier include mergers, acquisitions, etc.?
Yeah, could be possible. So it is basically performance of the restricted stock units can be based on performance of the company or performance of the employee or performance of both. So sure. If mergers and acquisition is one of the events which subject to which the vesting would happen, then definitely it has, but it has to be in the scheme. It has to be in the ESOP scheme or the RSU scheme.
Sure. All right. Sorry, just give me 1 second. Yes, to Akash Shaw's question again. There are separate applications for registration as a startup with DIP, and then we have to apply for 80 IAC registration.
Yeah, so DIPP registration is pretty easy. It happens in a span of 15 days to 1 month. The 8 IAC is one which is, which takes time because you have to prove deep tech or solving a huge problem or being an innovative company. So 8 IAC is what is critical here for the registered for that budget amendment benefit.
Sure. All right. The email and mobile has been put up in the chat. Tanya would request you to kindly share Deepak's official ID. Yeah, thanks. Ankur Agarwal would like to ask, how will the taxations work if the capital gains on ESOPs are paid out as a difference in the FMV and exercise price to an ex-employee and no share issuance happens?
Sorry, repeat that.
I'll repeat that. How will taxations work if the capital gains on ESOPs are paid out as a difference in the FMV and exercise price to an ex-employee and no share issuance happens?
The difference between the FMV and the exercise price.
Yes.
So it is a capital gains, right? So in this case, the employee has already exercised his option and he owns the shares. Even if he exits and post his exit from the company, he gets an exit option from the ESOPs, and will be taxed as capital gains if it's less than, if it's an unlisted company and if he exits in less than 2 years from the exercise date, then it is a short-term capital gains, and if it's more than 2 years, it will be a long-term capital gains.
All right, sure, thanks. So we'll just take one last question now by Sandeep. In a scenario where an employee is given joining bonus, which is fully taxed in the previous FY, and the employee leaves the company before fully vesting the bonus in the next financial year and has to return the bonus, is there a provision for the employee to reclaim the tax paid on the bonus?
So basically, this is bonus paid in cash, right? Not in form of shares. Okay,
Yes.
doesn't make a difference. See, when either if the employer, so suppose when the bonus is reclaimed from the company by the company from the employee, definitely his earnings would go down. And if the employer shows it in the form 16 that okay, his total salary was so much and so much has been the deduction on account of bonus reclaimed, and the net salary is so much, then definitely he can get the benefit. The employer has to show it in the form 16.
Right.
That is my opinion, but I can study and get back in detail. Prima facie, that's my opinion, because his net salary earning for that year would reduce by the amount of bonus reclaimed.
Sure. Deepak, there's just one question, the previous one by Ashok, where he was talking about the example. So we'll take that and close this. He was talking about in the slide where the exercise price was 60 per share with 10,000 shares. So how is that kind of taxed? The 10,000 into 60, how is it taxed? Is it by, is what he's asking.
So there is no tax on the 60 into 10,000. That's just the exercise price. That's what the employee pays on exercise. So there is no tax which happens at that point of time. The tax happens between the fair market value on the date of the exercise. So the exercise price is 60, and on the date of the exercise, the fair market value is 80 in my example. So 20 rupees is a notional gain which will be subject to tax as per present. So that 60,000 which he pays, or 6 lakhs which he pays to ABC Limited, 60 into 10,000, that's just a cash outflow from his pocket to buy those shares. So there is no tax incidence happening on that, but the tax incidence will happen on difference between the fair market value on the exercise date. In our current example, it is 80 rupees minus 60 rupees was the employee has paid to exercise those shares. So 20 rupees will be subject to tax as per present. I hope that is clear.
I think so. Deepak, thank you so much for your time, and thank you
pleasure.
everyone for joining. I think it would have helped clear out a lot of doubts in people's mind. We had a lot of queries on across our forums on
Thank you so much.
these. So thank you all. We hope to see you, many of you, tomorrow at Ankur Mittal's session.
Thank you so much. Thank you all for attending this session on a Friday morning. I know it's busy a Friday morning, but I really appreciate you all joining and listening to me, and I hope you got some decent takeaways from my session. Thank you so much, and thank you, CXOGenie. Look forward to more sessions like this.
Thanks. Deepak, if it's okay with you, we'll share your email that I think people are asking for in the emails that go out to the participants.
Sure, no problem.
Yeah, with the feedback link for everybody who needed that, we'll share it there.
No
Thank
problem.
you so much. Thanks.
Okay. Thank you. Thanks all. Have a nice day and a nice weekend. Bye.
You too.